In this video, we'll talk about you've done your analysis, now wait. Stay tuned. Hey traders, a very warm welcome to you. Okay, so bit of a kind of tongue-in-cheek title here, but what I want to really talk about is once you've done your analysis, many of us struggle with the patience to wait for that for the setup or the level we're interested in to happen, and we jump the gun. Let's do an example. All right, so we have a chart here and we've seen kind of the price do this, and it's kind of sitting in this nice little range, and we've defined a very, very strict area or very, very obvious area to us of resistance up here and support kind of down here. Notice I've not done it very, very clinically because the real world isn't like that, guys. We sometimes push through, sometimes push out. So we're sitting like this in this trade and the price is kind of doing this now. We're right in the middle of the trade. We defined areas on the chart we want to do business. As traders, we're looking for areas to do business in. We don't want to do business in any area that we don't feel we've got an edge. Otherwise, we're just gamblers, we're just punters, we're just playing the game that a lot of people are playing out there and are losing at. And we don't want to be doing that. We want to be more defined with this. And I've talked in previous videos about I prefer to kind of use a bit more of a zone for stuff, but you don't have to. You can use a defined level. The point is, again, define those areas to do business. So we have this kind of scenario now. Many of us will be itching to get into this. Many of us will be itching. The price will start to come down to here and we'll be itching to go long. But I've got to go long. It's so close to the support. I want to take it. We'll take it. But the problem with that, and okay, maybe it does go up and maybe we do get the exit. Maybe everything is nice. But in reality, guys, we know that our stop is going to have to be somewhere under this support level. It's going to have to be here somewhere. Okay, that's just pretty standard stuff based on the fact that if the premise of the trade is that support will hold, and that pretty much is obviously what it's going to be, then we want to come out of the trade when the premise is no longer there and it's broken. And that's going to be when the support is broken. Now, obviously, there are some kind of swings and roundabouts with that. How far do you take that? Do you have it really, really tight? Do you have it really, really low? That's something for you to decide, and obviously something for you to look at what's happened with the chart before. How many times have you faked out? You know, if every time you've done little wicks, you don't want to have your stop in that wick area. You kind of want to, you know, make a judgment based on the kind of market conditions you're trading. Let me get this. Actually, I don't need that. Right, so that's our stop level position. So if we're going in here, and let's say our stop is, I don't know, what's the distance between that? So that's 50, right? And the distance really between this and this is 20. You know, we are really skewing the risk reward on the trade. Because let's say the distance now between here and here is 50. All of a sudden, we've got a risk to reward ratio of 1:1, which isn't really what we're looking for. We may think that this thing's going to go up. We may think whatever we want, but in actual fact, we don't know, do we? We're just playing the game of odds. We're just playing the game of consistency and keep trading with the edge on our side, knowing that over time it's going to play out for us. So we skew that massively. Now, if we waited for it to come back down, and let's say, let's just scrub some of this off so we can see where we are. Let's say we waited now for this to come back down into our support level, and we're pushing down now. And now we get, okay, here we go. Oh, great. We can now take 20 pips risk or 20 ticks risk or whatever we're trading. And now we've got, what were we before? Let's say we've got 100 pips profit target. You know, our risk reward ratio has now gone from 1:1 to 5:1 or 1:5, however you want to look at it. You know, we're risking 20 to make 100. It changes the game significantly. Not only does it change the game significantly in terms of how much we can risk on the trade, because we can allocate more capital to that, and we've talked about that in a previous video, because the stop level is the same, but the distance between your entry and the stop is narrower, so you can allocate more trade size to that, the same risk, a monetary risk. But we now, you know, get the risk reward ratio is much more in our favor. You know, we can take many of these and be wrong and still be right and still make money from the one time we're getting it right. So you know, the point of this video, guys, is to say, listen, we all sit down and we all do this analysis. We all kind of spend the time putting our lines on our charts, being very thorough with it, or many of us do. But then when it comes down to it, we jump the gun. We wait. We don't, you know, we don't respect the stuff that we've done or the work that we've done in the cold light of day when the market is closed. So just a reminder of, hey, this is why we do it. This is why we do it. It's not only because we think that that's where the market's going to turn. That's the big one, obviously. But the second one is that it allows us to structure our trade better, both in risk reward and in terms of position size. And yes, you know, is this the holy grail of stuff? No, it's not. But it's adding these little things all together that's going to give us the best possible shot of making the sort of money that we want to make from our trading. All right, guys, if you enjoyed the video, give it a thumbs up. See you in the next one. Take care. Keep your risk managed. Goodbye.